to day 2 of BTL Blueprint, powered by Nova Financial, and I'm joined all this week by my guest and co-presenter Paul Mahoney, MD and also founder of Nova. And actually, Paul, we should point out a landlord as well. Would you mind sharing a few little insights into your own portfolio?
Yeah, absolutely. So my own portfolio is pretty well in line with what we generally recommend for our clients, and that is central locations in major cities. The areas we've been focusing on are the Midlands and the Northwest, or more specifically Birmingham, Manchester and Liverpool. So central areas focused at young professionals in areas which are somewhat limited from a supply perspective because land is a limited commodity, and where there's strong growth factors such as population growth, economic growth, infrastructure spending, all those sorts of things. And that's done me very well up until now.
Fantastic. Well, for this instalment, we're going to be talking about kind of when a newcomer comes into the property sector, how they can devise a strategy that's going to work for them, because I think we touched on the first video that it can be very, very overwhelming. And obviously there's some very high risk strategies and there's much lower risk strategies. So what's your view for somebody with no property experience at all when they come into the sector? What would be a safe way to get started where you're going to be able to sleep at night?
Yeah, okay. So I think just safe and being able to sleep at night are two key points there, absolutely. A big believer that investing isn't just about making money, as I said before, it's also about peace of mind and confidence.
Yes.
Because with your first investment, if you do it badly, or not even if you don't do it badly, if it just goes badly, you're probably going to be sort of once bitten, twice shy.
Yes.
You're not going to rush into it again. Which you don't want to rush into any investment, but you do want to continue to make progress. So firstly, I'd say your first investment should be a fairly safe one.
Yeah.
You should be investing somewhat similar to what I've just mentioned so far as what I've done. Investing in central locations, in desirable properties that are going to be desirable to a good target market. And my strategy there, and the strategy we often recommend for our clients, the reasoning behind that is, even it's easy to make money when the economy is doing well.
Yes.
And when the property market's doing well, anyone can make money. Where you need to be careful though is what happens on the other side of the economic cycle. In a recession, is there still going to be tenants available for your property? And certainly when you look at history, generally in central locations there are. Because there's still jobs, there's still facilities, there's still very strong reasons for people to live there. So even if property prices dip a little bit, your property is still rented, so it doesn't really matter. Whereas that's what we call depth in a market. The further you go from those central locations, generally, the more that depth tends to thin a little bit, and there's slightly less and less reasons for people to have to live there. And therefore, you can be slightly less confident in sustainability in bad times. So that's kind of, in a general sense, our view on mitigating risk when it comes to property investment. That's obviously especially important when it comes to leveraged property investment. So property with mortgages, which in our view is what really makes property a good investment. But you do need to consider the risks that are associated with that.
Of course, and we will touch on some more of those, I'm sure. I am a big advocate of novice landlords starting out with what I call a bread and butter workhorse, which is a buy-to-let terraced house in a good central area, like you said, with good transport links, good streets, in a good school catchment area. Do you have a view on houses versus flats?
So not necessarily on the type of property, but I look at it from kind of the other way around, if you like. I'd prefer to focus on the best location and all the fundamentals that support that location, and then let that determine what the best property is for that location. All of my properties are flats.
Oh, interesting.
And the reason for that is all of them are in very central locations. And in those very central locations, you've got single occupancy rates, which are kind of 65% of the market. If you add dual occupancy into that, so two people living in the properties, you're at over 80% of the market. So one and two bedroom apartments make sense in those locations. So that's been my strategy, and quite often the strategy that our clients follow as well.
Well, let's talk a little bit more about the conditions that we find ourselves in, because for somebody just starting out now in 2019. Obviously, we've got Brexit, we've got uncertainty, there's concerns about interest rates. You know, when there is so much uncertainty, I think it's even more important to play it safe. And, you know, particularly one thing that none of us can really have any crystal ball idea of is, you know, government intervention. We've already had a huge amount. We don't know even who's going to be, you know, in charge in a few months' time. It's so all up in the air. And I think, you know, just going, as you say, starting with something very, very low risk is probably even more important than ever in these conditions. And I get so concerned when I see, I've seen it today actually on Facebook, somebody saying, oh, I'm just starting out and I've bought a 7-bed HMO. There's so much legislation, compliance, tenant management skills needed. It's like putting a learner driver in a Ferrari.
Yeah, absolutely. And I think HMO is a big one. You know, it's a big buzzword, obviously. I think that the heat has come off it a little bit over the past sort of 18 months or so, but we just get so many people coming to us saying, I just want a HMO. And you ask them why, and you say, well, they'd say, well, aren't they really good? You know, they don't really know why, but someone might have told them at some point that they were great, you know. And again, we approach that from the opposite direction. You know, what is the goal? What are we actually trying to achieve? And then we work out, well, what's the best way of getting there, rather than starting with the product.
No, that does make perfect sense. I think also, you know, we mentioned everybody's kind of got a different starting point. I'm going to put you a little bit on the spot now, because we had a very interesting question came up when I was doing an interview with John Howard in front of a live audience, and somebody said, if you were starting out in the current market conditions now with £100,000, what would you do? And John gave his answer. So I'd just like to reframe that a little bit and say, you know, probably most people have access to maybe £50,000 if they're starting out. If a client came to you with that starting position, what would be your recommendation? Yeah,
okay, good question. And I'll sort of tie into that some of the things that I think are important in the current market because of the changes or some of the uncertainties. So, you know, £50,000 isn't a bad starting point, really, depending on the location that you want to look at. But if we're looking at leveraged property, and I'd certainly say that's the best option for that person with £50,000, rather than trying to buy something they can buy for 50 on its own, with a 75% buy-to-let mortgage, which is what I call the average maximum, meaning that's where most lenders will go to whilst still being at acceptable rates. You can go above that, but the rates tend to start to rise, and therefore it's less of a good use of your money. So we leverage that 75%. Obviously, we need to take out some. If they're a first-time buyer without a home, then they'll have very little stamp duty to pay. If they already own a home, then they'd have the extra 3%, so you need to account for that. They're going to have some legal fees and things as well. But let's say they can leverage that to about $180,000 after the costs. With that £180,000, they could go to any of the cities I just mentioned before, like Birmingham, Manchester, Liverpool, and maybe Leeds even. I'd say those 4 cities, from our perspective and our opinion, I suppose, have the strongest fundamentals in the current market, from the things, again, I mentioned before, like population growth, economic growth. I'm sure you've heard of things like the Northern Powerhouse schemes. A lot of major businesses moving a lot of jobs to those cities at the moment, things like HSBC and Deutsche Bank to Birmingham, Ernst & Young to Manchester, lots of jobs, especially services jobs moving to those areas. And also lots of young people moving from London. You know, net migration within the UK is now very strong to the north, and that makes sense in my view, because, you know, a young professional earning, you know, 30, 40 grand a year in London, they're really going to struggle to buy their first home. They're really going to struggle with living costs, and they move to those cities and they're not so much. So that's kind of some of the fundamentals and the reason we think those cities are quite good. I'd say buy as centrally as possible, buy the nicest property possible, because obviously demand is driven by desirability. So again, I wouldn't say to go and buy something you need to renovate or do any major works to, because you're just starting out. You want to start simple. So buy the most centrally located property, the nicest property possible that you know that you have worked out or you've got advice on is going to be under strong demand from a particular target market. You know, if that target market is young professionals, then you want things like bars, restaurants, cafes, and jobs on your doorstep. If it's a young family, then you want to have enough bedrooms firstly, you want to have schools, all those sorts of things. So work out who your target market is, and then what's the best location and type of property for that target market, or the other way around, either or. Talking about things that are important in the current market, yield is very important in the current market, because things like worries around interest rates and around lending, and that the recession, you know, the economy and things tie into that. You know, people are worried about Brexit causing a recession. You know, whether that happens or not, no one really knows what Brexit means or what the results of it are going to be. It's just a bit of uncertainty. I don't necessarily think it will be negative, and I think if anything, the market will pick up once all of this is resolved. But having that buffer on yield is very important, because, you know, if you've got an extra few £1,000s coming in per annum over and above all of your costs, well, if interest rates rise or if you have a bit of a vacancy period, it doesn't matter as much. And that's safety. You know, there's not really any other major risks with leveraged property investment. The two are interest rates and lending. They're the two main things. Renting your property out so you can service your mortgage and the cost of that mortgage. The other risks are pretty minimal, because as we've seen, you know, property tends to trend upwards over the long term. Even if the property price dips, so long as you've got a tenant, you're safe. So they're really the two main risks. I think a lot of people overcomplicate the risks of property investment, but they're really the two main ones. And they're relatively easily mitigated, so long as you're investing in the right properties in the right areas. So for this person, consider all of those things, get advice as much as possible, I'd say. You know, speak with people who have done it before. Speak with a mortgage broker as well. Make sure you get in place the right mortgages and things that work for you. Not only the cheapest mortgage, but if this person wants to buy again in 2 or 3 years, or, you know, recycle their money or keep building the portfolio, for example, putting in place a 5-year fixed mortgage doesn't make any sense. So making sure that they speak with a broker that understands their strategy as well. Get in place the right property management, because that's very important.
Very important. Particularly if you're buying remotely as well, because, you know, from what you're kind of saying, you're not necessarily saying to somebody to buy within like a 15-minute radius of where they live. There might be a more suitable investment for them remote from where they live. So property management is absolutely crucial to have somebody doing that for you.
Yep, absolutely. So generally, if you're speaking with the right advisor in these areas that are familiar with these areas, they should be able to help you with that. Having the right property management, very important. And then reviewing and reinvesting as time goes on. You know, don't just set and forget. Make sure that, you know, at least every sort of year or two, you're taking another look at your investment, seeing whether it might be worth remortgaging and reinvesting and kind of building as time goes on. I'd say they're the main pointers that I'd have for that person who's starting out.
Yeah, and I think what I've taken away from that, actually, and it's good to reiterate this point, is that, you know, the fundamentals of property do really remain the same. Yes, we've got all this government intervention, taxation, uncertainty, political, economic things going on, but actually, if you really you know, understand the fundamentals of property, you'll be able to see that you can still carry on. And I have to say, Paul, I love that saying that you told me in another interview, that it's not timing the market, it's time in the market.
Yeah,
and so many people will sit on the fence, you know, for years waiting for all the lights to be on green, and they might never be. You mentioned analysis paralysis. I think people do get into that, and they get stuck. And sometimes, you know, as I said, the lights always aren't on green. Yes, you've got to step forward safely, but you do have to step forward.
Yeah, absolutely. Yeah, taking action is absolutely key. You don't want to do it blind, but absolutely, you definitely need to implement.
Well, we're going to be talking about that throughout the week. And just a reminder that this themed week, BTL Blueprint, is loosely based on Paul's new book, The Property Pension Plan. We are going to provide a link underneath the video where you can get this book free just for the price of the postage. So do look out for that if you want to kind of deep dive into Paul's book. You can do that. But join us tomorrow, and we're going to be talking about the importance of mindset when it comes to investing. So join us there as BTL Blueprint Week, powered by Nova Financial, continues.